As I say, volatility is vitality. Bitcoin is a volatile asset. If you're going to hold the asset, you need a 4-year time horizon as minimum. A 10-year time horizon is really the right time frame. If your time horizon is less than 4 years, you should hold the credit instruments like digital credit. And if you're an equity investor in a digital equity like my company, you need that same 4 to 10-year time horizon.
The market's been struggling with the same things that it's grappled with all year, which is a monetary policy direction that's not completely clear. As you know, the odds of a December cut have really jumped around from as high as 60 down to 30 back to 80. And the second is, of course, policy volatility, because the administration does make proclamations and statements that are sometimes head fakes but confuse investors.
Bitcoin has experienced intense swings this November, dipping toward $80,000 after reaching highs of $126,000 in October, with a death cross pattern and minor sales contributing to the decline. Support holds around $78,000 to $84,000, but analysts spot rebound potential to $100,000 plus on seasonal Moonvember trends, which have historically increased by 10 to 40%, plus ETF inflows and Fed rate cut bets, with estimates jumping between 30% and 80% for December. Geopolitical noise and tariffs add pressure, yet long-term holders control 76% of supply, eyeing $165,000 year-end if key resistance breaks. Michael Saylor, in a recent interview, called Bitcoin's volatility its core strength, vitality that demands patience. He advised a minimum 4-year holding period, ideally 10 years, for direct ownership, warning that shorter horizons suit credit instruments like digital credit instead. Equity investors in Bitcoin-linked firms, he added, need that same extended view to ride out ups and downs. Meanwhile, Tom Lee pinned market struggles on murky monetary policy, where December rate cut odds have fluctuated wildly from 60% down to 30% and back to 80%. He also highlighted policy volatility from administration statements, often misleading head fakes that rattle investors and cloud direction. Watch the interview video for more details on Michael Saylor's latest analysis. Please like this video, subscribe to the channel, and set up post alerts to receive future content. Thanks for tuning in. Enjoy the rest of the video.
As I say, volatility is vitality. Bitcoin is a volatile asset. If you're going to hold the asset, you need a 4-year time horizon as minimum. A 10-year time horizon is really the right time frame. If your time horizon is less than 4 years, you should hold the credit instruments like digital credit. And if you're an equity investor in a digital equity like my company, you need that same 4 to 10-year time horizon. 4 is the short term, 10 years is the long term. I'm an officer of a publicly traded company. And what are we doing? We are in the business of buying a high energy, highly volatile asset and stripping the risk and the volatility off of it in order to sell it to people that are much more risk adverse, that are much more volatility adverse, that just want that yield. And so if Bitcoin wasn't volatile, it probably wouldn't be high performance. And then our value added wouldn't be that great, right? Like, for example, I say to people, if you knew Bitcoin was going to go up 2% a month forever with no volatility, neither you nor I would be in business, because all the conventional finance investors, all the conventional journalists, they would dominate the market. Warren Buffett would own all of it, and there wouldn't be an opportunity for us. I look at the volatility as it's a challenge, but it's also the bug is the feature. And I say to people, volatility is Satoshi's gift to the faithful. He basically gave you the ability to rise to the top of your profession as an analyst, as a journalist, as a corporate operator, as an investor. And if the volatility goes away, no one cares about your opinion on any of this. It's like, you've got fire, and we've got the phrase burned. Fire burns you and electricity shocks you. And Henry Ford created an automobile, with a burning engine, with a fire in the engine. And we created electronic transmissions And so you put electricity and fire in the car and you've got a killer consumer product. And I think the key here is you got to look at this market and say, this is indicative of energy. You can harness the energy. You can't be scared of the energy, right? There are those people that run from the fires, and then there's people that put the fire in the automobile or the jet airplane. And we kind of need the people to build the airplanes and build the automobiles if we're going to move the civilization forward. So the volatility comes with the territory. My message is, if you have a 4-year time horizon or longer, if you have money you don't need for 4 years, and you don't want to take any counterparty risk to a currency, a country, a company, a culture, a competitor, then you buy Bitcoin. And if you're an equity investor, and if you want amplified exposure, if you want to invest in the future of digital capital and the future of digital credit, and you're enthusiastic about, like, we think we can sell a treasury credit product that's really compelling and very interesting to 1 billion people, right? 1 billion people would love to have a bank account that pays 10%. If you would like to invest in that future as an equity investor and you don't need the money for 4 years or longer, then you can hold the equity. If you need the capital in the next 4 years, then you probably want to be a more risk-averse investor. You need to look at a credit instrument. And if you need exactly down to the penny, $87.17 in 2 weeks, you probably want to put your money in a bank or a money market because that's just what you need. And so I think every investor has to decide what's their risk tolerance, what's their time frame, and are you a credit investor, are you a capital investor, or are you an equity investor? And then once you've made that decision, you can decide how to allocate your portfolio. So I'm not concerned that we have these kind of concerns. I think we'll educate all of the companies in the space. Ultimately, it's above my pay grade to decide whether MSCI embraces digital asset holders or digital credit or not, just like it's above my pay grade whether the S&P 500 puts us in the index. But what I would say is, over the long run, it doesn't matter, because over the long run, this will create near-term volatility. But if the world wants a bank account that pays them 10% rock dividends, and if Bitcoin is digital capital superior to gold, then it's not going to matter what an equity index allocator decides. If the insurance companies don't want to buy Bitcoin and the banks don't want to buy Bitcoin, or the index allocator doesn't want to support a digital treasury company, the free market is going to allocate capital and it will adjust. It just creates a bigger opportunity for some other equity investor that will pile into this particular asset class and support these kind of companies. So it is what it is. It'll work itself out. I think whenever there's a lot of volatility in the market, and right now, clearly we've had a lot of volatility of late. We're living through about a 35% drawdown. You know, I remember what it was like when we had the crypto winter and there was a 75% drawdown. When you have a massive drawdown, everyone looks for a reason why, and they will grasp it. Is this the reason why? Everybody wants a reason for to explain their pain or the storm or the volatility. Is it the crypto exchange, liquidation bots, or is it this, or is it that? At the end of the day, if you look at the chart of Bitcoin for the past 15 years, there's 15 major drawdowns. It always comes back to an all-time high. There's 5 brutal pullbacks in the past 5 years. This is not the most brutal. All of those things have happened without the support of the politicians, without the support of the banking industry, without the ETFs, without the IBIT derivatives market, without the support of MSCI, without the support of the S&P index. I could go on and on and on. The reason that digital assets are spreading around the world is because there's 1 billion people. They want to hold the money in their hand. They want to move the money at the speed of light. They don't want to be dependent on 20th century financial structures. They don't trust gatekeepers. And they would like to move forward with their lives with some control, with financial freedom and sovereignty and property rights. And those fundamentals are stronger than ever. We just had the Secretary of the Treasury, Scott Bessent, show up at the launch of PubKey in Washington, D.C. last night, right? And so in the midst of all the, the crypto chaos and people worrying about, well, will these guys say that and will this happen? You have the most powerful financial regulator in the world implicitly showing his support for the crypto economy, for digital gold, for Bitcoin, and explicitly giving guidance to banks that it's okay to custody crypto assets, it's okay to actually handle them as part of staking and fee allocations, and it's okay to extend credit. And that is the most profound thing that's happened in 17 years in this industry. And if we keep our eyes on that, then the near-term volatility is just going to be noise. We have to work our way through it cheerfully, constructively. It'll eventually pass. People will look back and smile and say, you remember the day when that news story came out.
Bitcoin is a highly volatile asset, which creates both risk and opportunity. As an officer of a publicly traded company, the approach is to purchase this volatile asset and reduce the associated risk and volatility to offer stable yields to investors who prefer less risk. The volatility of Bitcoin is essential to its performance. If it were stable, it would lose its unique value and appeal. The challenge and opportunity lie in harnessing this volatility rather than fearing it, similar to how innovations like electric transmissions combined with fire in automobiles created breakthroughs. For investors, the time horizon and risk tolerance are key. Those with money they do not need for at least 4 years, seeking exposure to digital capital without counterparty risk, may consider buying Bitcoin or related equity positions. Short-term investors, or those needing precise returns, should consider more traditional, less volatile options like credit instruments or bank deposits. Despite near-term volatility and drawdowns, the fundamental demand for decentralized, fast, and sovereign money continues to grow, supported increasingly by financial regulators and industry developments. Let's now turn our attention to Tom Lee.
You had been saying, let's say a few weeks ago that we could get some choppiness in the first part of November, but you were still kind of bullish looking beyond that. What, in your view, has the market been contending with in recent weeks? What did we learn, and how does it set us up for the outlook here?
Yeah, well, I think the market's been struggling with the same things that it's grappled with all year, which is a monetary policy direction that's not completely clear. As you know, the odds of a December cut have really jumped around from as high as 60 down to 30, back to 80. And the second is, of course, policy volatility, because the administration does make proclamations and statements that are sometimes head fakes but confuse investors, and it's all resulted in really suppressed enthusiasm for stocks. Sentiment has been bearish.
And then that, led to a 5+% pullback in the S&P 500. A lot of the more aggressive parts of the market took on a lot more pain than that. Where does it leave us in your mind? I mean, as I mentioned, 4 days, this market has barely even flinched at pretty much all the hurdles that were along the way. The moving averages, we got above last Thursday's high. We know it's kind of an upside bias the Wednesday before Thanksgiving and the Friday after. But beyond that, where do we go?
I think we're set up for a really strong rally into year end. And I know we just came out of a pretty terrible grind. I've talked to a lot of PMs that have said it's one of their worst 6-week periods ever in their career. So we know people have lost money, they've de-risked. But we know into year end we have the positive seasonals, especially given how strong the May to October was. It's really a 5 to 6 chance that we're going to be up 5% into year end.
Right.
The second is monetary policy, I think, is going to shift dovish. Even if Fed Chair Powell is hawkish, we know it waiting in the wings is now a shadow Fed that's dovish. The third is we know sentiment is going to have to chase this rally because 80% of fund managers are trailing their benchmark. And then I think the fundamental story is pretty intact. As we're doing work into next year, and I think earnings visibility is going to be really good. So I don't think I'm questioning if earnings are peaking. It's more just that stocks price in and correct enough. I mean, we're almost through this year, and I'd say looking back, this was 5 years of history compressed into 1 year because we had a major bear market, the biggest tariff hikes ever. And that, of course, killed any hope of any 7,000 in the first half. But miraculously, stocks went into a waterfall decline and recovered every single point of that decline symmetrically. So it really speaks to the resilience. But I guess as we're thinking about next year, I bet you it's going to be very similar in the sense that we'll get a policy shock, maybe whether it's monetary or from the administration, it could lead to a big drawdown of 20% again.
Yeah.
But it's a replay of this year. And maybe we've now had 20% bear markets in 5 years. I mean, that's a lot of history compressed into a 5-year period. So in a way, it means crypto represents really a very precise measurement of risk appetite, because there's so much more leverage. And that got wiped out.
Right.
That last time it happened in 2022, it took 8 weeks before people sort of touch their toes back in. I think that's where we are. We're near a bottom. But now I don't think crypto leads. Crypto is lagging because it's really the AI that's going to be leading.
Okay, so basically that is kind of sidelined the idea of what, Bitcoin 150,000 you were thinking before?
Well, I think it's still very likely that Bitcoin's going to be above 100,000 before year end, and maybe even above one to a new high. So Bitcoin makes its moves in 10 days and every year. I think some of those best days are still going to happen before year end. Well, I know stocks have been sort of trading pole position, NVIDIA and Alphabet, but to me the bigger story arc remains that AI is a mega trend. There's a lot of resources and spending, and it's a big contributor to growth, and we know there's a shortage of both power and silicon. So I do think it's going to ultimately move in the next 12 months kind of as one cohort. I don't think valuation sensitivity is as important as people think. We're actually studying this now. We're going to be publishing it soon. But if you look back 10 years ago, the most expensive stocks at the end of 2015 continued to be the best stocks over the next 5 years.
Tom Lee explained that investor enthusiasm for stocks has been very low, with bearish sentiment dominating after a rough 6-week period that many portfolio managers described as one of their toughest ever. Despite recent losses and risk reduction, he saw strong potential for a year-end rally driven by positive seasonal trends, especially after strong performance in mid-October. He estimated a 5 or 6 in 10 chance that markets could rise by around 5% by the end of the year. Lee also suggested that monetary policy would shift toward a more dovish stance, even if Federal Reserve Chair Powell remains cautious, because a more accommodating shadow Fed is waiting in the wings. Since about 80% of fund managers were trailing their benchmarks, Lee expected sentiment to quickly follow any rally. He emphasized that the earnings outlook appeared solid going into the next year, with stocks likely reflecting that. Reflecting on the year, he described it as a compression of 5 years' worth of events, including a major bear market and the largest tariff hikes ever, which initially crushed hopes for gains. Stocks dropped sharply, but recovered every point, showing resilience. For next year, Lee predicted a similar pattern, possibly with another 20% drawdown triggered by either monetary or political shocks, continuing a trend of 3 such bear markets over 5 years. Regarding cryptocurrency, Lee said it reflects risk appetite tightly due to leverage, with the last wipeout in 2022 taking about 8 weeks for buyers to return. He believed crypto was near a bottom, but lagging behind other sectors, especially AI, which he saw as the market leader. Tom Lee remained confident Bitcoin could rise above $100,000, potentially reaching new highs, often making big moves in short bursts near year-end. He pointed to AI as the biggest long-term driver, with heavy investment, growth impact, and shortages in both power and silicon, expecting it to lift the broader market over the next year. He downplayed valuation concerns, noting research shows that the most expensive stocks at the end of 2015 went on to perform best in the following 5 years. Given Bitcoin's inherent volatility and the importance of a long-term investment horizon emphasized in recent expert interviews, how do you personally approach managing risk and timing in your Bitcoin investments? Please drop your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching. Don't forget to subscribe.